Welcome back to Gold Rush Reporter, your straight-talking source for gold and silver analysis. Today, we're diving into a conversation that mixes market reality, macro pressure, and the psychology behind why people gravitate toward precious metals when the financial system starts to look shaky. Before we even touch the economics, the hook is simple. People don't buy gold or silver because they expect a quick win. They buy it because they no longer trust the foundation underneath the currency they use every day. When the pillars of the system creak, debt, printing, banking fragility, metals stop being a trade and start becoming a lifeline. That's the lens you need to keep front and center. You heard it in the dialogue. Gold hitting record highs, silver lagging but historically undervalued, and a financial architecture built on debt rather than sound money. None of this is about gold suddenly becoming better. Gold hasn't evolved. It has remained the same since it formed in cosmic collisions. What changed is the currency measuring it. When fiat depreciates, the metal looks like it is rising. In truth, the unit of account is deteriorating. This is the point many viewers miss. They think gold goes up. In reality, the dollar is sliding down. And when you flip the perspective, measuring life in ounces rather than dollars, the narrative changes completely. Gold becomes deflationary, stable, consistent. Fiat becomes the variable, the unstable component. That instability is fueled by a system that prints money electronically, lends far more than it holds, and relies on confidence rather than reserves. Fractional reserve banking isn't a small leak. It is a structural condition where most deposits are already lent out. When confidence breaks, the system shudders, and we saw this repeatedly. Northern Rock, Lehman, Silicon Valley Bank. These weren't isolated events. They were symptoms. And the takeaway is brutal but clear. If your wealth depends on a system that can dilute your purchasing power while you sleep, you have a problem. Inflation doesn't destroy wealth slowly. It erodes it steadily while people remain unaware until it's too late. So the introduction today sets up a deeper conversation. Not hype, not gold is going to the moon, but a sober assessment. The fundamental structure of money is weakening, and precious metals remain one of the few assets that sit outside that structure. Now we move from the conceptual foundation into the mechanics, the stuff that actually drives gold and silver demand when the financial system starts wobbling. You heard a lot of narrative in the interview, but underneath it, there is a very clear economic structure. Fiat currency loses purchasing power because it is expandable, while precious metals do not. That asymmetry is what creates the price behavior people misinterpret. When a government prints money, it does not increase prosperity. It increases nominal balances while decreasing real value. The inflationary effect is subtle day to day, but brutal over time. Workers earn more on paper, but their purchasing power shrinks. This is why the middle class feels constantly squeezed, even when nominal wages rise. Inflation is not a side effect. It is the core outcome of the system. Gold and silver sit outside that mechanism. They are not liabilities. They do not depend on a borrower or a central bank. They cannot be expanded by decree. That is why in crises, 2008, the banking stress events, even smaller regional bank failures, metals respond in the opposite direction to risk assets. When confidence collapses, risk on assets fall because they require leverage and expectations. Gold rises because it requires nothing. This distinction matters because it cuts through the noise. You cannot analyze metals the same way you analyze equities or bonds. Equities rely on future earnings, debt, and optimism. Bonds rely on repayment and trust in the issuer. Metals rely on physical scarcity and historical monetary function. That is why the narrative in the interview repeatedly returns to the erosion of fiat foundations rather than any change in gold itself. The fractional reserve system is a perfect example. Banks lend far more than they retain. That system functions only while depositors remain calm and the maturity structure stays stable. When it breaks, even modestly, the whole mechanism reveals its fragility. The crises you heard described were not accidents. They were the expected outcome of a structure built on confidence rather than reserves. When people internalize that, even at a basic level, demand for hard money rises. Not because it is glamorous, but because it is predictable. Hard assets provide certainty in environments where certainty is disappearing. Silver plays into this differently. It behaves both as a monetary metal and an industrial input. That dual identity makes it more volatile and often underpriced relative to gold during stress periods. But historically, sharp silver moves follow gold moves once monetary pressure intensifies. Up to this point, we have established the philosophical and mechanical reasons why gold and silver attract demand during periods of economic stress. Now, we transition into the behavior of markets themselves. Metals do not move in isolation. They move because investors, institutions, and even governments react to stress signals in predictable ways. When confidence in fiat systems weakens, capital reallocates. The first reaction is usually a shift into assets perceived as safe. Traditionally, that has meant government bonds, but the interview makes it clear that this channel is losing credibility. Short-term treasuries still attract buyers, but long-term debt is being shunned because investors understand the repayment risk and the inflation risk embedded in those instruments. That leaves a gap. When both equities and bonds fail to provide stability, investors search for something that does not depend on an issuer. Gold fits this role. Silver follows, though with more volatility because it carries industrial demand on top of monetary demand. Once investors start questioning the foundations of fiat, even a small shift in sentiment produces disproportionate flows into metals because the supply base is finite and largely held in long-term custody. Another behavioral factor is the psychology of crises. People do not wait for absolute collapse. They act when uncertainty reaches a threshold where the upside of holding risk assets no longer justifies the downside. That threshold has been crossed repeatedly in the last 2 decades: 2008, the pandemic, regional banking stress, and even recent treasury market dysfunction. Metals rally not because they predict crises, but because they offer a hedge when uncertainty spikes. Silver complicates the narrative because it often lags gold during early stress periods. Investors focus on gold first because it is the purest form of non-liability money. Silver, being cheaper and industrial, is seen as riskier, even though historically it exhibits higher upside. Once the monetary component dominates, silver accelerates. That is why ratios compress sharply during major cycles. What matters most is the shift in the investor base. Central banks have already turned from net sellers to net buyers. Sovereign demand is structurally increasing because the global reserve system is fragmenting. Private investors follow that shift. Retail demand rises because people sense instability. Institutional demand rises because portfolio risk models begin flagging fiat depreciation. This creates a self-reinforcing dynamic. Metals rise not through hype, but through allocation pressure. And because physical supply cannot be expanded quickly, price becomes the adjustment mechanism. Now we shift from investor behavior into the structural pressures that actually drive the metal cycle. Markets don't move because people feel something. They move because constraints build up until the system has no choice but to reprice risk. Gold and silver become the release valves when those constraints tighten. The most critical constraint is government debt. The US is sitting on an enormous pile of short-term obligations, and the rollover schedule is brutal. When a government has to refinance trillions in a single year, it creates a liquidity bottleneck. Investors already show reluctance toward long-dated treasuries because they see duration risk, inflation risk, and political risk bundled together. That leaves the treasury market thinner and more fragile than it appears. When private demand weakens, the central bank steps in. This is the core mechanism behind the modern inflation cycle. The government issues debt, the market hesitates, and the central bank fills the gap by creating money. This isn't a conspiracy, it's a mechanical response built into the structure. But the consequence is the same every time. More currency units chasing the same goods, which erodes purchasing power. Gold responds because it sits outside that closed loop. It doesn't require a borrower, a lender, or a promise. When the debt machine strains, gold becomes the only asset class not entangled in the system. That's why it rallies during stress even when everything else collapses. Silver follows, but because it has an industrial side, it moves in a more jagged pattern until the monetary component dominates. Another pressure point is banking liquidity. Banks operate on a maturity mismatch, borrowing short, lending long. When interest rates rise or when long-duration assets fall in value, the mismatch becomes lethal. Silicon Valley Bank wasn't a mystery. It was a textbook failure of duration risk and confidence. Once depositors doubt the balance sheet, the bank collapses because it never held enough reserves in the first place. This fragility is not an exception. It is the rule. Fractional reserve banking works only while confidence remains intact. And confidence is the most volatile component in any financial system. As soon as it wavers, capital flees toward assets that do not rely on someone else's promise. Gold fits that definition perfectly. Silver does too, but with more noise, because industrial demand floods the signal. Still, the underlying force is the same. Systemic stress increases the demand for assets that cannot be diluted. We've mapped the philosophy, the mechanics, the behavior, and the structural stress points. Now we connect the dots into the implications. Metals do not rise because they feel safe. They rise because the financial architecture pushes capital toward assets that cannot be diluted. The debt cycle is the pressure cooker. Governments rely on constant refinancing. When markets resist, central banks intervene, expanding the currency base. This creates a feedback loop where debt issuance and money creation reinforce each other. Inflation becomes the natural byproduct, not an anomaly. Investors react rationally in this environment. They don't chase metals because they expect speculative gains. They shift toward assets with no counterparty risk. Gold sits at the top of that list. Silver sits slightly below it, but with higher upside potential once the monetary component dominates the industrial noise. What matters is the timing of these shifts. Metals move sharply when the system reaches a point where traditional safe assets fail to provide stability. That is the moment when the allocation pressure becomes concentrated. The rotation into gold accelerates because it is one of the very few assets capable of absorbing large demand without the risk of default. Central banks amplify this movement. Once they flip from sellers to buyers, the supply available to the market shrinks. That tightening has nothing to do with sentiment and everything to do with balance sheets. When official demand rises while investment demand rises, the physical market cannot remain static. Silver exaggerates the cycle because it is thinner, more volatile, and more sensitive to marginal flows. When gold moves first, silver eventually follows, and when it follows, it moves with far more amplitude. This is not a story about silver catching up. It is a story about a structurally tight supply meeting structurally rising demand. These pressures build quietly and then release violently. Markets don't adjust smoothly when the underlying constraints are mechanical rather than psychological. Metals absorb the shock because they sit outside the debt for money mechanism. We've walked through the mechanics, the behavior, and the structural pressure points. The conclusion is simple because the system itself is simple. A debt-based currency cannot maintain purchasing power when the issuance of liabilities outpaces the economy's capacity to absorb them. When that imbalance grows, capital migrates toward assets that cannot be diluted. Gold fits that requirement cleanly. Silver participates because it shares the same monetary foundation, even if it carries additional industrial noise. None of this relies on sentiment or narratives. It relies on constraints. Debt must be refinanced. Markets resist duration. Central banks intervene. Currency units expand. Confidence erodes. Risk assets falter. Non-liability assets absorb demand. That sequence repeats because it is built into the architecture, not because investors feel anything. Gold remains the anchor because it has no counterparty and no issuer. Silver remains the lever because it is smaller, thinner, and more sensitive once the monetary component dominates. Together, they form a hedge that doesn't depend on promises, policy, or optimism. For viewers, the takeaway is not a prediction, but a framework. When the financial system strains, metals become the default store of value because they sit outside the strain. You don't buy them for excitement. You buy them because everything else is tied to a liability. And that's the core message. Thanks for watching Gold Rush Reporter. We keep the analysis clean, direct, and grounded in structure, not noise. Until next time, stay aware and stay prepared.